So if you think back to the last press conference that Jay Powell gave, he said that they feel like monetary policy is in a good place and that it would take a, quote, material reassessment of the outlook for them to continue to cut rates. And our forecast has what will cause them to do a material reassessment. We think people are underestimating the hit that the tariffs already in place are going to have on the U.S. economy. And if we still get the tariffs that are scheduled for December 15th, that will be an additional kicker. But then we're looking for a big slowdown in the U.S. economy in the first half of the year, with growth averaging something like 0.5% at an annualized rate in the first half. So that's a big slowdown, and that's going to be enough to get the Fed's attention and to change their tune.
So again, it comes back to what I was discussing with Aaron earlier, and that the market is underestimating the impact that these tariffs, the existing tariffs, are going to have on the U.S. economy. Forget about extra tariffs also being applied. What do you think is going to be the catalyst for the Fed, though, to get spurred back into action? Is it going to be one rogue, super low non-farm payroll print? Will it be another contraction in ISM? I mean, what will be the catalyst for them, do you think?
So I don't think it will be a single non-farm payrolls print, but I do think non-farm payrolls are going to be key. Listening to what Jay Powell said, there are two parts of the economy that he sees as giving them strength, giving resilience to the U.S. economy. And if that's the area that's got the strength, that's where you want to look for the weakness. And that was in the job market. So we're going to be looking at the initial claims for unemployment insurance and the non-farm payroll prints. That's going to be key. And then it's consumer spending, household spending. And so we'll get the retail sales data, we'll get the monthly consumer spending numbers. And if we're right, and we see a repeat of exactly what happened last year in Q4 as the tariffs were hitting the manufacturing sector, as we saw initial claims for unemployment rates, unemployment insurance starting to rise, we saw a fall in consumer spending. That same pattern we fully anticipate will start to happen a little bit over the next several months and then very much into next year. When you see that weaker job market, weaker household spending, that's going to get their attention.
When have you got the first cut penciled in for next year?
So a little bit punchy. We have it written in for January. That could easily be a little bit later. It could take them a bit of time to assess the data, but the fourth quarter is already tracking a little bit to the soft side, and we think there's going to be enough data accumulated by January, but maybe that slips until the March meeting.
You know, I'm interested to see your view, because we've talked a lot about tariffs and the impact on the U.S. economy. Just how fast or how high the U.S. economy or GDP would be growing if none of this trade war had started from the beginning. I mean, how much do you estimate the tariffs have costed the U.S. economy at this point?
So when I think about last year, in the middle of the year, the U.S. economy was growing something like 3 to 4% in the second quarter and the third quarter. And then we had this massive slowdown to about 1.2% in the fourth quarter. That slowdown was a reflection of the tariffs hitting the manufacturing sector, throwing people out of work, reducing spending. And it continued, if you just focus on the domestic sort of final purchases in the U.S. economy, that slow growth continued into the first quarter of this year. And so you've got 2 quarters that were growing at 1.25%, 1.5%, instead of where they should have been closer to 3%.
Now let's talk about the Fed's independence. Yet again, yesterday, President Trump used the opportunity of his speech to rail at the Fed for not cutting interest rates enough. And so far, they've held their ground, sticking to their independence, you could argue. But how closely do you think the Fed will be watching the elections? And 2020 is going to be a big year also for the future of the trade war as well, future relationships with China.
Yeah, so the Board of Governors of the Fed is in Washington. I'm a lifelong Washingtonian. Everyone in Washington will be paying attention to the election. But when it comes to actually making policy, I spent 15 years at the Fed working on monetary policy strategy, writing recommendation memos to the committee, sitting in the FOMC meetings, briefing the committee. And of all the Fed rhetoric, I think you can literally take at face value their continued statements that the election won't have any impact on their actual policy decisions. And you see that in practice. I mean, the last several elections, there have been monetary policy actions going up right up until the election. And I suspect they're going to use their best judgment, and whatever the economy calls for, they'll deliver.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.